Mr. Oudea, thank you so much for being with Bloomberg TV.
You're welcome.
In the fourth quarter, you got your net income coming out at 875 million euros, revenues at 6.2 billion euros, and your CET1 ratio at 12.7%. Are you satisfied with what you've achieved, especially in terms of capital in the past year? And what's the next step? Is that improving your profitability?
Listen, when we look at the full year, I think it's fair to say we've met all our objectives, whether it was regarding commercial activity or financial performances, and in particular regarding the capital, which was our main priority. I think we've exceeded our targets. We end the year with 12.7%. I think it's very positive. It will give confidence, and we've also complied with the commitment to pay a good dividend of 2.2 euros per share in cash to our shareholders. But I would say that beyond, we've been also successful, I think, in the adaptation of our businesses, and that translate in the fourth quarter with good dynamism of the revenues. That's very positive and encouraging for 2020.
You are saying that your net income in 2020 should actually be higher than in 2019 if we stay in the current environment. What makes you say that?
You know, we've given relatively precise figures and guidance for all our businesses, and in particular for all our retail activities. We have a good visibility, it's obvious. Regarding the GBIS, we've completed the restructuring in 2019. So we are very confident that we have now a very good business model where we have dynamism in the revenues in the fourth quarter. So the engine to generate revenues is there, and we will get the benefit of this restructuring for the full year, the full benefit in 2020 on the cost side. So that's why we are confident to improve effectively the net income and the profitability on the capital. Your
investment bank's revenue, GBIS, are up 7.1% for the last quarter. Fixed income up 27%, equities up 9%. So the demand for structured products has recovered recently. Have you seen a strong recovery there?
First of all, if we look at the FIC business, the 27 should be read as plus 40 if you take into account the businesses that we had in the fourth quarter of 2018 and that we have closed. So it's a better performance actually, and effectively in the equity, I think compared with our peers, it's pretty good at plus 8%. Yes, in particular in the equity derivative business, the performance was good, and I think again it's the same thing, it's encouraging for the future. Our engines, our expertise are there, and I think they can deliver.
Still, SocGen's equities franchise is now about more than 50% larger than your fixed income division. How do you plan to keep gaining market share?
Listen, historically we've always had a bias towards equity, and I think that's not necessarily bad, in particular when I see certain players withdrawing from equities and concentrating on fixed income. So I think that I'm happy with that. On the fixed income, I've seen good development. We've refocused the franchise, we've exited certain businesses, but where we are, I think we can compete. And of course, we are a leader, in particular in equity derivatives, and we want to maintain this position.
What could be, in your opinion, the biggest headwind for your equities franchise going forward in 2020?
Listen, I would say when we look at this year, overall the perspective is probably better than people anticipated 6 months ago. It's fair to say that there is this virus issue in China. It's not at all the exposure we have in China, direct, which is small, but like any company, what it could mean for the global economy. So let's wait. There's a lot of uncertainty. Hopefully, there will be, of course, a solution for that. But beyond this, I would say we are pretty confident. Yes, we have a slowdown in the economies, but something relatively moderate in mind. And again, in our case, we deliver better performance in 2020 thanks for all the hard work which was done in 2019.
Some economists are actually saying that the growth forecast for China could be cut by as much as 2 points for the first quarter. Would that have a big lasting effect?
I think really the question is how long it will last. If it lasts 2-3 months, I think yes, there might be impact, but it's not such a big deal. Given the importance of China, if it lasts more, that can be more significant for many companies and for many economies. So let's wait.
SocGen was among the banks studying the conditions for setting up a new security entity in China, given the new regulations there. Do you think the situation is actually delaying this?
No, listen, here we talk about very long-term perspective. We talk about a progressive opening of the capital markets, the development of asset management. Here, again, we talk about much shorter-term impact. Nothing. There's no direct impact on this project that we want to pursue.
How are you dealing with the situation with your teams there? Are they staying home? Are they coming to the office? How are you dealing with the travel there?
Like any company, of course, our priority is to ensure the safety of our staff. Yes, we ensure that. Fortunately, so far, we have no one with the virus in China. What we do is organize ourselves to ensure effectively that we can have business continuity, but we adapt and people stay at home and do the business from home. And yes, we have decided to stop the trips, as anyway many airline companies have stopped themselves. So we are adapting. The focus is on the safety of our staff, and again, we'll see how it goes going forward.
In France, your French retail revenues are up 2.3% in the fourth quarter. We also had a few headwinds at the end of 2019. We've actually the first contraction of GDP since the beginning of President Macron due to the strikes. Are you feeling the strikes effect, and are you confident about growth in France in 2020?
Listen, first of all, 2019 is a very good year when you factor the low rate, negative rate environment, which weighs on the deposit margin. But overall, as you mentioned, slight increase of the revenues, which is above our expectation. We had in mind a slight erosion. And overall, thanks also to the good monitoring of costs and risks, a profitability which remains at the same level than last year. So it's pretty resilient. Now, the economy in 2020, we should have something like 1.1%, a slight decrease, but consumption should remain pretty supportive for the French economy, which is less exposed than other economies to export.
In terms of ECB policy, of course, the negative rate environment have been weighing on banks. Do you believe the new two-tiering policy of the ECB has helped mitigate those effects, and do you think this is going to help in 2020?
Listen, it has helped, as you said, to mitigate but not compensate, because beyond the direct impact, the negative rates have more wider impacts on the saving industry. We have 190 billion euros of liquidity, which is there, available, liquid assets. Of course, the yield is not very high in this environment, so what I would say, it weighs definitely on banks, and we see that for all Eurozone banking activities, in retail in particular.
The Bank of France government was saying that this system will actually help diminish the cost for French banks this year by 800 million euros. So it's going to be better.
But again, it has mitigated. Yes, it's better. I think it was a good decision. But again, when you think about the billions that we pay and have to not to have on the interest margin because of the interest rate, it's lower. But again, it was a good move.
Is this the number one difficulty to improve your profitability?
Listen, I think banks are facing different challenges. First of all, absorb the regulatory new framework. Second, transform fundamentally with the new digital technology. And here the profitability will come also from it being more efficient. And we are very moving forward as quickly as possible, and I think we've delivered also in our objectives. And then, as you said, on top of that, it's fair to say that in the Eurozone, fortunately not in our international retail, not in financial services, in our French retail, we have this negative impact. We are happy to have activities outside France from that perspective and outside the Eurozone, which are not suffering at all in the same way.
Do you believe your cost cutting is behind you now?
The cost cutting will carry on. Let's be realistic. This industry has to make further progress, has to embrace the new technology to improve the client experience, but also to be more efficient. And so I don't think it's finished. I mean, year after year, like any industrial company, we will have to think about making further progress. What is true is that a restructuring like the one we did in GBS is behind us, and this year it is reaping the fruit of all that, having a more business model, and I'm convinced that we can deliver a good performance, and the attention should be there. But the cost discipline will remain across the board and for years, and that's true for all European banks, I think.
Unlike BNP Paribas, you've said time is ripe for cross-border consolidation. Andrea Enria from the ECB has said he's going to try to remove some of the barriers in order to encourage this cross-border consolidation. What are we looking at? Are we looking at something this year with Societe Generale looking, for example, at Italy or Germany?
Can I amend this? I did not say that it is now the time. I think nothing will happen. It's not the right time. What I've said is just that when you look at the mid and long term, more consolidation should be a logical outcome of a completed European banking union. The problem is that it is a construction which is half completed. And we need first to have more visibility, more understanding of what is the end game to start thinking whether it can make sense. So it's not for now, it's not for tomorrow, it might be in the midterm. For the time being, the priority, and so we see nothing this year, our priority is to finish the job in 2020 on the profitability, on the transformation of our business model, with the same discipline on cost and capital.
You're one of the longest standing banking CEOs in Europe for more than a decade, and Bloomberg reported last month that the search for your successor has actually started, even though your term is another 3 years from now. Are you participating in this search?
Listen, first of all, I'm effectively one of the longest serving, but I'm still one of the youngest, so I have a lot of energy. Let me just remind you, I was just renewed a few months ago by our shareholders at 96%, and I have a mandate of 4 years. So I am committed to that. You will see that the board has been very happy with the performance of 2019, and really all the teams, myself, we are committed to deliver. That's what is important.
Finally, Brexit has finally happened. Are you moving?
Yes.
Are you moving staff across Europe at the moment, or are you still in a wait-and-see attitude until we find out what the next rules are?
Listen, Brexit has happened. I would say to a certain extent, as such, it was not an event. It did not trigger any specific reaction. Now we are embarking in this negotiation with no change of stance. As you know, we have a very balanced presence between Paris and London. We have adjusted where it was needed. It was something relatively limited, and we want to maintain this presence. We adapt to the new regulatory framework. We are ready, and now we are waiting to see how things will develop going forward, in particular in the financial services industry.